Hello student, this is the financial accounting course. My name is Amir Shala in الأكاديمية العربية الدولية. So first of all, in the table of contents, let's say that we are going to talk about an introduction. First of all, we are going through an introduction at first. Then we will go through general accounting principles. Here we are going to talk about main ideas, about general statements, about general factors that accounting and financial accounting is actually related to. Then we will go through the accounting equation, which is actually the most basic equation in accounting, which is found in all sorts of accounting related to this kind of accounting, which is financial. And at last, of course, we are going to talk a general view about financial statements, the 3 or 4 main financial statements that we are going to talk about today. And at last, of course, we are going to have some exercises that we are going to use in order to deeply understand the concept, and of course to do some practices on how to use those equations and how to use those financial statements and how to implement our understanding about the whole course that we are going to talk about. So first of all, in our introduction, we will talk about business. So what is business in general? Okay, so business is an entity formed for the purpose of carrying on commercial enterprise. So it's simply an entity, a corporation, a company that is made, okay, in order of doing commercial activities, meaning at the end, and over here we are going to talk about the profit businesses. So there are another kind of businesses that is not actually interested in profiting. This is not what we are going to talk about today. We are going to talk about the businesses that are interested in making profit, so that are interested in making commercial activities. Okay, such an organization is predicated on systems of law governing contract and exchange, property rights, and incorporation. What do we mean by that? We mean that those organizations, those entities that we are going to talk about, is related to the system, must respect the government law in which they exist, and must respect, of course, that law that is related, of course, to the contract of the business, the law of exchange, the property rights, the incorporation rights, etc. Okay, so the financial accounting in any business is related to the country, to the laws, of course, that business is found in. The objective of most businesses, as spoken earlier, is to earn a profit. So most businesses, as we said, is there to earn a profit, to make sales, to make activities, to make transactions in order to make profit after all. Okay, so we are going to talk about this kind of businesses. Let's not talk about the businesses that are not interested in profit. Okay, let's focus on this. So what is profit after all? Profit is the difference between amounts received from customers and amounts paid for inputs. So what do I mean by that? Revenues minus expenses. Profit is equal to revenues minus expenses. In other words, revenues are the money the company is receiving from customers or from the sales activities. Okay, what are the amount paid for inputs? Let's go over here. Let's say that we need raw materials in order to create our product. Let's say that we need some costs over here in order for logistics to transport our products to somewhere. Let's say also the marketing costs, the operation costs, everything that is paid in order to sell is considered to be a cost after all. Okay, and every penny received from customers is considered to be revenues. So how to calculate the profit after all is simply by taking the whole amount of revenues, all of them, add all of them, subtract from the answer the amount of all of the expenses added to each other. So there we are going to have our profit. Moving on to types of businesses. What do we mean by this? So businesses, profit businesses, are actually divided into many types. We have first service businesses. So what is a service business? A service business provides a skilled service, personal labor, or expertise instead of a physical product. For example, we have the airlines, entertainment companies, etc. So what do we mean by this? Simply, we are selling intangible products. So those products are not touched. Those are only services. That's why we call it intangible. Okay, so it's a service just like the airlines, for example, as said, the flight from a country to another. Okay, the entertainment, the hospitals are considered, the insurance companies, those are services. We cannot touch those services, but we are able to use them as customers. So that's why we consider those businesses to be service businesses that sells intangible products. Moving on to another type of businesses, the merchandising businesses. Those are companies that buy products and then resell them to end customers, whether online or in brick-mortar stores. Merchandising businesses are specific to products rather than services. So those over here we have two parts. For example, the retail stores. Over here we have two parts. The first part is that they buy products and then they resell those products to the end consumers. So what do we mean by this? We simply, just like the retail stores, just like Carrefour, Walmart, etc., we simply buy products from a business which is a wholesaler, and then we take those products, resell them to the final consumer. When I say final consumer, I mean that is the consumer who is going to use those products for personal use. Okay, he is not going to resell them anymore. Those products are for his own use. So first of all, merchandising businesses are the businesses that buy products and resell them to the final consumers or end consumers. Okay, this transaction, this selling process can be done online, like many pages online, like just let's say Amazon.com or AliExpress, any type of business that is considered to be an online business, or in brick and mortar stores, the retail stores like Walmart, like Carrefour, etc., that actually sells physical products that are not online. You need to go to this store in order for you to buy the product that you are searching for. Okay, the other part is that merchandising businesses are specified or in selling products rather than services. This means that they mainly sell tangible products. That means products that I can sense, I can touch. Okay, so tangible products, not services. In order, then we are selling tangible products. Okay, we have a third type of businesses. This third type is actually the manufacturing businesses. What are those? A manufacturing business is any company that uses raw materials or components to create finished goods. Manufacturing businesses make most of the products we use, including electronic devices, furniture, medical equipments, aircrafts, etc. For example of this, car manufacturers. So, what do I mean by this? In other words, in other terms, those are the businesses that are simply creating the product, manufacturing it from scratch. Different than the previous type of business that we already talked about, the merchandising, which is actually considered would consider buying the product from a wholesaler and then or from a manufacturer and then selling it to the final user. This business actually manufacture the product. They do not buy it from any other business. So they use raw materials in order to do that, components, of course, any other stuff that is needed to create this product, and then sell it to some other business maybe, or to a final consumer. There is no difference there. Here we are talking about electronic devices like Toshiba, HP, Samsung, Apple, etc. They manufacture their products and then they sell it to the consumers or to the companies that are willing to sell it. Furniture, medical equipments, aircraft, cars like Mercedes, like Honda, like any other type of cars that actually has its own manufacturer. So over here we will start talking about accounting. So what is accounting in general? It's an information system that provides relevant and timely information to users about the economic activities and condition of a business. So accounting is simply a system of information, okay, that actually provides relevant and timed information. When I say timely information, I mean it is related, it has a timeline, it has a timetable, okay, it's timed to users about what? It's all about the economic, the financial activities and the financial or economic condition of a business. So what's a process? A process identify users, assess information, needs of users, design the accounting information system to meet users' needs, record economic data about business activities and events, prepare accounting reports. So simply, the process that we are talking about over here is how to implement accounting. In other words, in simpler words. Okay, so I'm willing now to do accounting, I'm willing to implement accounting. Okay, I cannot do that from nothing. I need to follow a specific process. Okay, and this process is actually identified, helps me to assess those information that I'm talking about, to do the accounting system that I'm willing to, in order to meet the user's need, and the user's need over here is the company's needs. Okay, so the company's needs to understand its financial situation, for example. So there we use the process of accounting in order to do it, to record the economic data, to have some archive about it, and to prepare accounting reports, which is actually the most important part. What is then managerial accounting? Managerial accounting provides internal users, which are managers and employees, with the information they need. For example of this, private accounting. So over here we have a company, let's say. That company has its own, of course, revenues, has its own expenses, has its own transactions. So through the time, this company needs to follow up its own financial situation. So in order to do that, it needs essentially, and it's very important for it, to have an internal accounting, in other words, managerial accounting, that is going to provide this financial data, financial situation, for what? For the managers and for the employees, of course, that are in need of those information, for them to keep following up with the company performance. So this is very essential for the performance of the company. Another type, the financial accounting. So what is financial accounting? It simply provide external users. What do I mean by external users? I mean investors, creditors, customers, government, with the information they need. Example for that, general purpose statements. Okay, so we have an managerial accounting as spoken for internal use. Financial accounting then is for external use. Why do we need that? As said in the beginning of this course, we have, for example, the government, the laws of the government that actually is going to be respected by the company, and those laws asks the company to have financial statements and financial accounting, to have some financial information about the company's revenues, expenses, taxes, etc. So it's all about this sort of information. The investors, for example, they also need to know about the financial situation of the company. So that's why we have financial accounting data for them. The creditors, the customers, all of those are going to ask the company sometime and somehow about its own financial accounting. So that's why we have the general purpose statements for them. What are the Sarbanes-Oxley Act? It's actually established a new oversight body for accounting after scandals with information reporting. For example, the Enron company scandal that happened before, and that's why we have such acts established. So this is an act that simply is going to organize the accounting and the financial statements in order to prevent such scandals from happening all over again. Another type, just like the Certified Public Accountant, CPA. So what do we mean by that? CPAs help individuals and companies with financial planning, investments, taxes, mergers, acquisitions, etc. So a CPA, a Certified Public Accountant, is someone who is an accounting, who has been able to have a certification from the government, let's say, okay, to help the companies with the financial statements and with the financial planning, etc. So the company is going to take this CPA's financial statements as let's say, as legal and as trusted, that has no scandals, etc. So those individuals are there, as said, to help those companies with the financial statements and the investments, the taxes which is related to the government, of course, mergers, acquisitions. Mergers like the company is going to merge with someone else, or acquisitions is the company is going to acquire another one. So all of this needs an accounting process and the financial statement to be there. So there the CPA is going to be to help the company to provide the government with the right statements and with the right reports. Let's go into general accounting terms. First of all, we have GAAP. GAAP, pronounced as GAAP. Those are set of rules to follow when reporting financial information. Allows comparisons among companies. Let's say FASB versus IASB. There is some differences there that we are going to talk about later, okay? But let's just talk about GAAP now. It's a set of rules, a set of principles, let's say, that are there to follow when reporting the financial information of the company. Okay, so we cannot just report anyway. We need to follow, as said earlier, some principles, some rules for the government and for everything else. So there we need GAAP. Business entity concept. So businesses are viewed as an entity separate from its owners, creditors, or other businesses. Let's take an example with this. Facebook is seen as a virtual entity if you want to refer to it, other than its shareholders. So let's say that we have a company. This company has many shareholders. Okay, so if we want to refer to this company, Facebook as an example, or any other company, if we want to refer to it, this company has actually its own personality. Okay, it's an entity. So we cannot refer to it directly by referring to the shareholders. No, the shareholders are there, but if we want to refer to the company, we will refer to it by its name. Okay, its virtual entity, its virtual personality. So in the general accounting terms also, we have forms of businesses. We have, for example, the proprietorship, we have the partnership, we have corporation, we have limited liability companies, LLC. So those are many forms of businesses, okay? And each form of business there is going to have its own financial statements, or in other words, its own accounting terms, its own accounting principles. Cost concept. Amounts are initially recorded in the accounting records at their cost, purchase price, regardless of asking price, market value, etc. Why do we need that? First of all, we need that when we are going to calculate our profit, mainly, so we need to know what is the correct concept, what is the correct cost concept. So we need objective concept, which are correct concept, and we will need this as a unit of measure, after all, in order to measure our profit. So when I say this, we are going to later on do some exercises about this, but when I say it, I mean simply that whatever price was for the product that the business is going to buy in the market, we are not going to look for this. We will simply be interested in the actual purchase price that the company has actually paid for the product. Okay, forget about the asking price, forget about the market value. We will simply look for the actual paid price, for the actual paid money. We reach the accounting equation now. So in order to go there, first of all, we will need to explain some concepts. The first concept, which is a very basic and a very important as well concept in accounting, which is assets. So assets are actually resources owned by the business. Okay, here we have the right of creditors, people who lend money, right of owners, people who invest money. So in a business, everything that is found inside the company, for example, okay, is considered to be an asset. Cash itself is considered to be an asset. So assets are actually the main factor that forms the company. Equipment, buildings, etc. Even employees. Now we go to another term, which is liabilities. What is liability? Liability is a term in accounting that is used to describe any kind of financial obligation that a business has to pay at the end of an accounting period to a person or a business. Liabilities are settled by transferring economic benefits such as money, goods, or services. So in other terms, in simpler terms, liabilities are the money that we owe to another person or to another business. Fast example about this, let's say that we are buying some products on credit. That means we are not going to pay for those products on site or cash. We are going to simply buy on a note payable, for example. Okay, so after 6 months we are going to pay the price of this product. So this is a liability for 6 months. Okay, we owe the company that we already bought these products from, we owe them money. So this is a liability. Okay, now the third term, which is owner's equity. It is defined as the proportion of the total value of a company's assets that can be claimed by its owner. Whatever it was, a sole proprietorship owned by one person or a partnership owned by more than one person, and by its shareholders if it was a corporation. It's calculated by deducting all liabilities from the total value of an asset. Over here we reach the equation equity equals assets minus liabilities. Okay, so again, equity equals assets minus liabilities. This is why we have explained all of those terms in order for us to reach this equation at the end, equity equals assets minus liabilities. In other terms, if we want to calculate the assets, assets are equal to what? Liabilities plus owner's equities. So what do we owe? What does the company have? What the assets, as explained before, is simply what is the company formed of? What does the company have? So it's what? It's the liabilities. It have its own liabilities. It owns its own liabilities plus the owner's equity plus the other things that the company already have other than liabilities. So assets is equal to the liabilities plus the owner's equity. We can rearrange this formula in order to find any missing amount. So let's take an example for this. If assets increased, let's say, by $50,000, liabilities decreased by $25,000. So what is going to be the change in owner's equity? As seen in the formula, we have an increase by 50,000. It's equal to negative 25,000 because we have a decrease there, plus owner's equity, which is the unknown that we are trying to search for. We simply add 25 because we took it to the other side of the equal sign. So there we are going to change the sign from negative to plus. Owner's equity there is going to be $50,000 plus $25,000, which is equal to $75,000 at the end. So there we have found the owner's equity value. There we have business transaction. What is that? A business transaction is a financial transaction between two or more parties that involve the exchange of goods, money, services. To engage into a business transaction, the business exchange must be measurable in monetary value so it can be recorded for accounting purpose. So simply a transaction, a business transaction is simply when two or more parties, two or more persons, two or more companies, a company with a person, that actually do an exchange. When I go to a supermarket and I simply buy a product, I'm doing a transaction there. Okay, when a company or a business goes to another business, buys some raw materials, this is a transaction. It can be done through goods, money, they can be exchanging services, so all of those are transactions. To engage, to do a business transaction, the business exchange must be measurable in money. I need to be able to measure monetary this exchange. I need to be able to say how many dollars this exchange is equal to. Okay, why do I need to have a monetary value for it? Because I need to record it in accounting. Okay, so this is very important. Now when I say account payable, AP in short term, is simply a short-term debt and a liability on a balance sheet where a business owes money to its vendors or suppliers that have provided the business with goods, services on credit. Explained before, the account payable is an account that is found on a balance sheet. Where do we put our liabilities? That is actually when we owe money to another business, like a vendor or like a supplier, okay, and we haven't yet been able to pay all of the money. Okay, it can be timed, it can be on other terms, it's up to the deal made. Okay, but what is an account payable? So it's where we put the liability, where we are going to put the amount of money that we owe another business. So what is a prepaid expense? A prepaid expense is an expense that has been paid for in advance, but not yet incurred. In business, a prepaid expense is recorded as an asset on the balance sheet that results from a business making advance payments for goods or services to be received in the future. So this is actually somehow the opposite of account payable. There we do not have the product yet, but we have already paid the money. In account payable, we have the product, but we have not yet paid the money. So there's the difference. They're almost the opposite. So a prepaid expense is when we have already paid in advance for the product that we are willing to buy, but we have not yet received this product, and it goes into the asset of the business when we are willing to put it in the balance sheet. Now what about the revenue? The revenue is the money a company earns from the sale of its products and services. Cash flow is the net amount of cash being transferred in and out of a company. Revenue provides a measure of the effectiveness of a company's sales and marketing, whereas cash flow is more of a liquidity indicator. Here we can talk about the fees earned, the sales, the interest revenue, the rent revenue, whatever kind of revenue that you can think of. So what is that? In other terms, in simpler terms, to explain this sentence, it's the money earned by the companies. Okay, simply it's like that. What is then a cash flow? The cash flow is simply the flow of the cash in and out of the company. So they're in to the company, that means it's revenue. Out of the company, this is an expense. Okay, so the act of revenues and expenses, the flowing of them is called cash flow. Account receivable. Account receivable refer to the money a company's customers owe for goods and services. They have already received them but not yet paid for. For example, when customers purchase products on credit, the amount owed gets added to the account receivable. So there it's a similar concept for the account payable, but over here we own money. Okay, the customers actually owe us money. So it's not that we need to pay money for another business or for another person later on. We already have sold a product to a customer. That customer has not yet paid for us the full amount of money for this product. So there we are going to put this record in the account receivable part. Expenses. An expense is defined as an outflow of money or assets to another individual or company as payment for an item or service. Create professional invoices for free with sum-up invoices. An expense is a cost experienced by a company paid out to suppliers or for products or services from other sources. So an expense is simply an amount of money, as said, outflow. It's going outside of the company, or I am paying for something, so this is an expense. Okay, it's a cost experienced by the company, paid to supplier, paid to for a product, for a service, for raw materials, or any other source, any other type. After all, it includes supplies used and payments for employees' wages, utilities, and other services. So it's simply anything, any cost the company is actually having. Owner's equity again. Owner's equity is the portion of a company's asset that an owner can claim. It's what's left after subtracting a company's liability from its assets. We've already talked about that. Owner's equity is listed on a company balance sheet. So there we're going to find owner's equity on the balance sheet. Owner's equity is simply the portion of the company's asset that an owner can claim. It's something that I already have. It's not a liability. It's there. I already own it. Okay, so example for this: purchasing supplies on account affect the account payable part. What do I mean by that? When I affect the account payable, I am affecting the liabilities there. Okay, so it's not an owner's equity. Now we reach the financial statements part. So the primary financial statement of a proprietorship are income statement, statement of owner's equity, statement of cash flows, we have balance sheet, and they are prepared in the following order. We have first, we need to do them by order because each one of them goes into the second one, into the next one. So the first one to be prepared is the income statement. Second, statement of owner's equity. Third, the balance sheet. Fourth and last, the statement of cash flows. The income statement now reports revenues and expenses for a period of time based on the matching concept. Matching expenses incurred during the period the revenues was generated. So over here, the income statement is going to be done over a period of time. We are going to simply put the revenues there. We are going to simply put the expenses in it. And after all, you already know that now. Profits are what? Revenues minus expenses. So when we put there the revenues and then we put the expenses, we will be able then to calculate the profit in general. Okay. Net income or net loss is revenues minus expenses. What do I mean by net loss there? I mean that simply if the revenues was smaller than the expenses, less than the expenses, there the company is losing money, and there we are going to call it net loss. When the revenues are larger than the expenses, bigger than the expenses, there we are going to say that the company is actually earning money, and there's going to be called net income. The second statement that we're going to talk about is the statement of owner's equity. Here we simply report changes in owner's equity for a period of time. So again, it's going to be over a period of time. Prepared after the income statement because you need the net profit or the net loss to be put there. Before the balance sheet because owner's equity, and we refer to it over here by OE, is reported on it. So what do I mean by that? Simply, why do I need to prepare the income statement before the owner's equity statement? Because simply I need the net profit or the net income in other terms, or the net loss. I need to use it when I will be preparing the statement of owner's equity. So there I need to prepare the income statement before it, and then I'm going to use that owner's equity on the balance sheet. So that's why I need to prepare that statement, the statement of owner's equity, before preparing the balance sheet. Now we reach the balance sheet. So what's the balance sheet? A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity. Again, assets are everything owned by the company. Its buildings, its equipment, its employees, it's everything. Liabilities are what the company owes for other persons or companies. What do we need to pay for? And shareholders' equity are the owner's equity after all. So shareholders are the owners. The balance sheet is one of the three core financial statements that are used to evaluate a business. So actually I have two more statements that I need to use in order to evaluate a business. The balance sheet is the third one, and is actually very important because it simply evaluate a business. It simply tells us if the business is losing money, earning money, if it's going forward, or if it's simply going downwards. It provides a snapshot of a company's finances, what it owes and what it owns as of the date of publication. So over here it's on a specific date. It tells us what does the company owns, what does the company owes for others on a specific date. It reports the amount of assets, the amount of liabilities, the amount of owner's equities on a specific date. So this is why balance sheet is very important. This is why it's the third one. We already use in it the owner's equity statement, that we have already used the income statement in it prior. So actually it gives us a wide view, an overall view, a general view about the business situation, about the business performance, financial performance of course. And as said in the beginning of this course, we are talking about the businesses that are interested in making profit. So that's why the balance sheet is that important for this business. It simply gives us at a specific date, at the end of the year, for example, or at the end of the semester, or at the end of the whatever time needed for the company, it gives us the general view about the financial situation of the company. What about the statement of cash flows? A cash flow statement provides data regarding all cash inflows that a company receives from its ongoing operation and external investment sources. The cash flow statement includes cash made by the business through operations, investments, and financing, the sum of which is called net cash flow. Okay, so simply the cash flow statements give us the data, the information needed about all of the cash inflows that a company actually receives from its ongoing operations and external investments. So what I mean by this, I mean the ongoing operations, the sales operations, the marketing activities, etc., the external investments, any type of inflow for the company. So it's any type of cash made by the business through those investments and stuff. Okay, so the sum of which again is called net cash flow. Report cash flows from operating activities, investing activities, financing activities, in other terms. So after finishing the financial statements, the four main financial statements that we already covered, we have first of all the income statement, second we have the owner's equity statement, the balance sheet, and last we have the cash flow statement. Now we are going to do some practice problems that are actually very important and essential in accounting in order for us to deeply understand what are we talking about in this course. So the first practice problem is going to be this one, the following. Equipment with an estimated market value of $40,000. So the first number that we already have over here is the estimated market value, is $40,000, is offered for sale at $55,000. So its market value is 40,000, it's okay, but it's offered for sale, it's selling at $55,000. This equipment that we are already talking about is acquired for $17,000 in cash. So the company was able to acquire this equipment for $17,000 in cash and a note payable of $20,000 due in 30 days. So what am I saying over here? That the company was able to acquire this equipment. First of all, it's going to pay $17,000 in cash directly, and after 30 days we are going to pay another $20,000 in order to continue to complete the payment. So it's a note payable. The amount used in the buyer's accounting records to record this acquisition is, we have four different choices to choose from. A, $40,000, which is the market value. B, $55,000, which is the selling value. C, $37,000. D, $17,000, which is the amount paid in cash. So the correct answer actually over here is C. Since we don't care about the market value or how much is offered, we only care about what we have actually paid for, which is $17,000 in cash and another $20,000 in 30 days. It's going to add to become $37,000. So there the answer is simply C. Another practice problem. We have a business that paid $10,000 to a creditor in payment of an amount owed. The effect of the transaction on the accounting equation was to, we have four choices again. A, increase an asset, decrease another asset. B, decrease an asset, decrease a liability. C, increase an asset, increase a liability. And D, increase an asset and increase stockholders' equity. The correct answer is going to be B, because simply paying money to a creditor means decreasing a liability. So we already owe that creditor money. Let's say we already owed him $20,000 in total. We gave him 50% of this, which is $10,000. So now we only owe him another $10,000. It's not $20,000 anymore. So we have decreased the amount of money owed by us, and that means we have decreased the liability there. And of course we have paid him this amount of money cash. Okay, so that means the assets has decreased, because as said when we were explaining the concepts in the beginning of the session, cash is an asset. So that's why paying cash is going to decrease assets too, right? Assets are going to decrease there. So that's why the correct answer is going to be B, decreasing an asset by paying cash, decreasing a liability by simply reducing the amount due on the company. The third practice problem that we already have: which of the following financial statements reports information on a specific date? We have three options: A, the income statement; B, the statement of cash flow; C, the balance sheet. We have already explained this when we were explaining the financial statements. The correct answer is C. A and B, the income statement and the statement of cash flow, are over a period of time. They are not at a specific date. Only C, only the balance sheet is for a specific date. And as said during the explanation, let's say for example the end of the year balance sheet, there we are closing the year, and there we are simply looking at what financial situation we are in on the balance sheet. So that's why it's going to be, it has to be on a specific date.